Compounding sucks at the beginning. It really does. You put money in every single month, you glance at your balance, and it feels like you're barely inching forward. Then someone tells you to just be patient. Just wait it out. But nobody tells you the part that actually matters. There's a real identifiable moment when everything shifts. A specific turning point where the numbers stop crawling and start taking off. Today, I want to walk you through the exact framework that predicts when that shift happens. It's called the 7531 rule, and once you understand it, you'll never look at your investment account the same way again. Let me introduce you to someone. We'll call her Veronica. She's 28, earns a solid income, and for the last 5 years, she's been putting $200 into her investments every single month. She's done it right. She's stayed diversified, stayed consistent, never touched the money. But when she pulled up her account last month, she saw roughly $14,000 sitting there. And her gut reaction was, is this even worth it? 5 years of discipline, and she could spend that entire sum in a matter of months if she wanted to. This is exactly the point where most people give up. They assume compounding must be broken or that they're doing something wrong. But Veronica isn't making any mistakes. She simply hasn't reached the tipping point yet. And knowing exactly when that tipping point arrives is what separates the people who quit too soon from the people who actually build real wealth. Compounding isn't additive. It's exponential. Picture pushing a stalled car. In the first few minutes you're straining, your legs are on fire, and the car barely creeps forward. But once it picks up speed, once momentum kicks in, it suddenly gets easy. That's exactly how compounding behaves. The trouble is that most financial advice tells you to keep pushing, without ever explaining how long that struggle will actually last. That's what we're going to fix right now. Let's start with the first number, 7. 7 years is the minimum stretch of time you need to commit to before compounding starts to feel real. I know your first reaction, 7 years, sounds like an eternity. But there's real data behind this number. Researchers examined the S&P 500 all the way back to 1926, and here's what they found. If you invested for any random single year, you had roughly a 74% shot at coming out ahead. Decent, but not great. Stretch that window to 7 years, though, and your odds of profiting jump past 95%. And here's the part that really stands out across every single 7-year stretch in the S&P 500's history. The average annual return was positive. Every one of them. 7 years is long enough to absorb the chaos. It gives you room to weather a rough year, a crash, and a recovery and still come out on top. Anything shorter than that. And you're essentially gambling on where in the cycle you happen to land. There's a psychological reason this matters too. When you're only investing for a year or two, your brain keeps scanning for proof of progress. You check your balance constantly, measure it against what you've put in, and feel let down because the growth looks tiny. But once you commit to a 7-year horizon, something changes in your thinking. You stop fixating on month-to-month swings and start seeing the bigger picture. Your portfolio stops feeling like a lottery ticket and starts feeling more like a tree you planted, and you don't judge a tree by its height in year 2. You judge it by whether it's still growing come year 7. That mental shift alone makes this rule worth learning. But committing to 7 years won't help you if your money is sitting in the wrong places. That's where the second number comes in. 5. 5 categories of diversification. Not 5 random stock picks, and not 5 index funds that all track the same thing, 5 genuinely different asset types that move independently of one another. Category 1 is broad market index funds. This is your base layer, something like an S&P 500 fund or a total stock market fund, giving you a slice of hundreds or thousands of companies at once. When the economy expands, this grows with it. It's steady, dependable, and historically has averaged around 10% annually over the long haul. This should make up the largest piece of your portfolio, somewhere between 40% and 60% for most people. Category 2 is dividend-paying stocks or funds companies that grow in value and also hand you cash on a regular basis. Think of names like Coca-Cola, Johnson & Johnson, or Procter & Gamble, all of which have paid dividends for decades. The advantage here is that these payments keep coming even in flat markets. You can reinvest them to compound faster, or later in life you can live off them as income. Aim for roughly 15 to 25% of your portfolio here. Category 3 is small and mid-cap growth stocks, smaller companies with more upside potential, but also more turbulence. They swing hard in both directions. Still, over long stretches, small caps have historically beaten large caps. Between 1926 and 2020, small cap stocks averaged about 11.9% a year compared to 10.2% for large caps. That 1.7% gap sounds minor, but stretched across 30 years, it's the difference between ending up with $174,000 versus $227,000 on a $10,000 investment. A reasonable allocation here is 10 to 20%. Category 4 is international exposure, and it's one people tend to overlook even though it's essential. The US accounts for less than 60% of the global stock market. Staying purely US focused means missing out on major growth happening across Europe, Asia, and emerging economies. On top of that, international markets don't always move in lockstep with US. Markets, when one dips, the other can hold steady or climb. That balance acts as a cushion. A range of 10% to 20% in international funds makes sense. Category 5 is defensive assets, your safety net. Bonds, treasury bills, or a modest cash reserve. These won't grow much, but they also won't crater. When stocks drop 30%, bonds might fall only 5% or stay flat altogether, which keeps you from panic selling everything when times get rough. Depending on your age and appetite for risk, this could be anywhere from 10 to 30%, with younger investors leaning lower and older investors leaning higher. Why does spreading across these 5 categories matter so much? Because compounding falls apart the moment you get wiped out. Say you dump everything into one hot tech stock. It doubles, and you feel like a genius until it crashes and you're down 60%. Now you need a 150% gain just to break even. That's not compounding, that's gambling. But when your money is spread across these 5 buckets, there's always something carrying the weight. Stocks slide, bonds hold firm. The US market cools off, international picks up the slack. Growth stalls, dividends keep flowing. That resilience is what keeps you in the game long enough for compounding to actually take hold. Now, even with the right time horizon and the right mix of assets, there's still a major obstacle standing in your way: your own emotions. Which brings us to the third, number 3. 3 emotional stages that will try to sabotage your compounding before it ever gets going. Stage 1 is doubt. It shows up in the early years. You're contributing consistently, but your balance looks unimpressive. Meanwhile, you watch a friend make quick cash flipping crypto or day trading, and you start second-guessing yourself. Maybe I'm doing this wrong. Maybe I should be more aggressive. Maybe compounding is just something the wealthy say to keep everyone else patient and poor. That doubt creeps in every time you check your balance, and if you give into it, you'll abandon your plan, chase something flashy, and reset your entire timeline. Stage 2 is frustration, and it usually hits around year 3 or 4. By this point, you've put in thousands of dollars, but the returns still feel underwhelming. You expected exponential growth, and you're seeing something closer to a straight line, and it starts to feel pointless. This is when people pull their money to buy a car, take a trip, or throw it into a friend's startup, anything that feels like tangible progress. But frustration is actually a sign you're getting close. It means the base has been built and the compounding engine is starting to warm up. Quitting here is like shutting off the oven right before the food finishes cooking. Stage 3 is panic, and it hits when the market crashes, because it will. In 2008, the market fell 37%. In 2020, it dropped 34% in a matter of weeks. When your balance drops below what you've actually contributed, fear takes the wheel and you start thinking, if I don't get out now, I'll lose everything. But here's what the data actually shows. Every single crash in history has been followed by a recovery. The 2008 crash fully recovered by 2013. The 2020 crash fully recovered by that same August. Anyone who sold during the panic locked in their losses and missed the bounce back. Anyone who held on or kept buying came out ahead. Panic is the most dangerous of the 3 stages because it convinces you that you're protecting yourself when you're actually torching your future. So how do you get through all 3 stages? You build a system that keeps you grounded. First, stop checking your account daily. Set a real rule for yourself once a quarter, or even just once a year. The more you look, the more emotional you get. Second, automate everything. Set up automatic contributions so willpower is never part of the equation. When the market dips, your automated investment scoops up more shares at a lower price that's dollar cost averaging, and it's one of the most effective tools available to you. Third, measure your progress differently. Don't just stare at your balance, look at how many shares you own, how much you've contributed. Celebrate the consistency, not just the returns, because in the early years, consistency is the actual win. And fourth, study the history. Read up on the dot-com bubble in 2000, the 2008 financial crisis, Black Monday in 1987. Every single time, people panicked, and every single time the ones who stayed invested came out ahead. Once you know that history, you stop reacting on instinct, because you realize this is just part of the process. You've made it through doubt. You've made it through frustration. You've made it through panic. Now we arrive at the last number, 1. 1 annual increase to your contribution. This is the piece that separates people who build decent wealth from people who build life-changing wealth. Here's the math. Say you invest $300 a month for 30 years at an 8% annual return. You'd end up with roughly $48,000. Solid, but not extraordinary. Now say you bump that contribution by just 5% every year. So year 2, you're putting in $315 a month. Year 3, $331. Year 4, $348, and so on. That one adjustment pushes your final balance to over $787,000. Nearly double, just from a 5% annual increase. Why does it work so well? Because it mirrors how life actually plays out. Your income rises over time, raises, bonuses, paid off debts, and if you redirect even a sliver of that growth into your investments, you supercharge the compounding effect. Think of it like lifting weights. Bench press the same 100 pounds every week for a year and you'll get stronger, but eventually you'll plateau. Add just 5 more pounds each month though, and you keep progressing, because your muscles never get the chance to fully adapt. Money behaves the same way. Flat contributions produce flat growth. Rising contributions produce exponential growth. And here's the beautiful part: you barely feel it happening. A 5% bump on $300 is just $15, roughly the cost of skipping 2 coffees a month. But stretched across 30 years, that small tweak adds nearly $400,000 to your total wealth. That's the power hiding in that single number, a tiny annual nudge you hardly notice today that completely reshapes your future. So what does it actually look like when you follow this whole system? Committing to 7 years? Spreading across 5 categories, surviving 3 emotional stages, and increasing your contribution once a year? Let's go back to Veronica. She's 5 years in, $200 a month, sitting on about $14,000, and frustrated. But instead of walking away, she decides to apply the 7531 rule. She commits to 2 more years to hit that 7-year mark. She rebuilds her portfolio across the 5 categories. She mentally prepares for the emotional stages ahead. And she raises her monthly contribution to $210, with a plan to increase it 5% every year going forward. By year 7, her balance sits around $24,000 better. But still not dramatic. She's still in the slow build phase. But keep going. By year 10, she's at $42,000. Year 15, $89,000. Year 20, $156,000. And by year 30, having kept up that 5% annual increase the whole way, she's sitting on more than $500,000. Here's the wild part. In the final 10 years of that 30-year run, she contributed less than $75,000 total. Yet her account grew by over $300,000 in that same stretch. That's compounding. That's the curve everyone talks about, the point where your money starts working harder than you do. The first 10 years, she laid the foundation. The next 10, she built momentum. The final 10, she watched it take off. None of that happens if she quits at year 5. Now let's look at the research backing all of this up. Fidelity studied more than 5 million retirement accounts and found that people who stayed invested for at least 7 years without drastically altering their strategy ended up with balances that were, on average, 60% higher than people who kept switching approaches. Dalbar, a financial research firm, tracked investor behavior across 20 years and found that the average investor earned just 3% annually because they kept jumping in and out of the market based on emotion. Meanwhile, the S&P 500 itself returned 8.2% a year over that same span. The gap comes down to time and consistency. Investors who stayed put and followed a system captured the full return. Those who reacted emotionally captured roughly half of it. There's more. Vanguard studied diversification's impact and found that portfolios spread across multiple asset classes experienced 20% less volatility than portfolios concentrated in just 1 or 2 areas. Less volatility means less panic. Less panic means you stay invested longer. And staying invested longer is really the entire game. And on the contribution side, a Charles Schwab report found that investors who raised their contributions by just 1% a year ended up with 25% more wealth after 20 years compared to those who kept contributions flat. Now imagine what a 5% annual bump does. This isn't speculation, it's documented, researched, and proven. So why doesn't everyone do this? Because it's boring. There's no adrenaline, no overnight windfall, nothing to brag about at a party. It's just slow, steady, disciplined effort stretched over a long period of time, and our brains are wired to hate that. We crave instant results, instant validation, instant proof that we're doing something smart. But compounding doesn't operate on our timeline. It runs on its own clock, and the only way to win is to match it. The 7531 rule lays out the roadmap: 7 years to smooth out market cycles, 5 categories to guard against catastrophic losses, 3 emotional stages to anticipate and push through, and 1 annual increase to accelerate growth without straining your budget. Here's how to put it into action starting today. Step 1. Commit to 7 years, minimum. Write it down somewhere you'll actually see it and treat it as non-negotiable. Step 2, rebuild your portfolio across the 5 categories. If you're unsure how, a target date retirement fund or a robo-advisor can handle it for you. Step 3, automate your contributions completely. Set it up once and stop relying on willpower. Because willpower fails and automation doesn't. Step 4, prepare for the emotional stages ahead of time. Write down exactly what you'll do when doubt shows up, when frustration hits, when panic sets in. Maybe it's calling a friend. Maybe it's rereading a book on investing. Maybe it's pulling up historical market charts, whatever it is. Decide now so you're not making a rash call later. Step 5, schedule your annual contribution increase. Set a reminder every January, every birthday, and raise it by 5%. If you get a raise at work, bump it even more. Automate it through your brokerage if that option exists. This isn't about getting rich quickly. It's about getting rich inevitably. Because once you follow this system, wealth stops being a question of if and becomes a question of when. The math guarantees it. The data backs it. The only variable left is whether you have the discipline to stick with it. And discipline isn't something you're handed, it's something you build. You build it by sticking with 7 years, even when 5 feels long enough. You build it by spreading across 5 categories, even when one option looks tempting. You build it by pushing through 3 emotional stages, even when quitting feels like the easier path. And you build it by raising your contribution every single year, even when staying flat feels comfortable. One more example to drive the point home. Meet Tom. He's 35, starts investing $400 a month, and follows the 7531 rule from the start 7-year commitment. Proper diversification, mental preparation, and a 5% annual increase to his contributions. By 42, he's at roughly $50,000, not life-changing yet, but he doesn't quit. By 50, he's at $165,000. By 60, $480,000. And by 65, ready to retire, he's sitting on more than $750,000. Over those 30 years, he contributed roughly $350,000 total, but compounding tacked on another $400,000, his money did more work than he did. That's the entire payoff. That's what happens when you let the system play out fully. Now compare that to his friend Jake. Jake also starts at 35 with $400 a month, but he doesn't follow the rule. He panics during a downturn in year 4 and pulls everything out. He waits 2 years before jumping back in. He pauses his contributions for a year to buy a new car. He never once raises his contribution. By 65, Jake has about $320,000. He put in roughly the same total amount as Tom, but because he wasn't consistent, because he didn't stick to the system, he ends up with less than half of what Tom has. Same starting point, same total contributions, wildly different outcomes. That's the difference structure makes. That's the power of the 7531 rule. So here's a challenge. Don't just watch this and move on, actually act on it. Pull up your investment account right now. Take a look at your portfolio. Does it reflect the 5 categories? If not, fix it. Then figure out how long you've actually been investing. Are you past the 7-year mark? If not, commit to staying in until you are. Next, think back to the last time you raised your contribution. If it's been over a year, bump it up today, even if it's only $10 more a month. And finally, write down your plan for each of the 3 emotional stages. What will you do when doubt creeps in? When frustration hits? When the market crashes and panic sets in? Decide now, because when those moments actually arrive, you won't have the clarity to think it through in the moment. But if you've already made the decision, all you have to do is follow the plan. Compounding feels slow because it is slow, especially at the start. That's not a flaw, that's the design. It filters out the impatient and rewards the disciplined. It separates the people who want to feel wealthy from the people who actually become wealthy. The 7531 rule is your filter, your compass, your reminder that real wealth isn't built in a day, a year, or even 5 years. It's built across decades. And the people who understand that, who accept that, who commit to that, are the ones who end up with genuine financial freedom. So stop waiting for the perfect moment. Stop waiting for the market to feel safe. Stop waiting until your income is higher. Start now, follow the rule, and let compounding do exactly what it's built to do: turn time into money and discipline into wealth.